Every month you pay rent or your mortgage, you're voting with your money. Right now, millions are asking the same question. Why are mortgage rates still high? And more importantly, when will they drop? Today, I'm going to cut through the noise, explain the real reasons rates are elevated in 2025, what drives them day to day, and the exact steps you can take right now to protect your buying power. Mortgage rates are high because long-term borrowing costs are high. That happens when inflation expectations remain elevated, when investors demand higher yields on long-term bonds like the 10-year Treasury, and when the broader economy, jobs, wages, consumer spending suggests higher prices ahead. Put simply, lenders want to be paid more to lock in money for 30 years. Let's unpack the main drivers, one by one. When inflation stays above the Fed's 2% target, investors demand higher returns on long-term loans to preserve purchasing power. That expectation flows directly into mortgage-backed securities, MBS pricing, and the yields investors require, which lenders pass on to borrowers. Mortgages don't directly track the Fed's short-term rate, they track the longer end of the yield curve, especially the 10-year or Treasury. When the 10-year yield rises, mortgage rates generally follow because investors compare the return of MBS to Treasuries. When the Treasury yield is higher, mortgage rates must rise to stay competitive. The Federal Reserve influences short-term rates through its policy rate and signals about future policy. Those signals shape inflation expectations and the economic outlook. If the Fed signals persistent tightness or fewer cuts than markets expect, long-term yields and mortgage rates tend to remain elevated. So the Fed matters, but the market reaction through bond yields is the main transmission channel to mortgage pricing. Financial institutions bundle mortgages into securities and sell them to investors. If demand for MBS drops, lenders need to offer higher rates to attract buyers. Conversely, strong demand can nudge rates lower. Global events, pension flows, and regulatory shifts can change demand quickly. Finally, individual mortgage offers include lender margins that reflect business costs, borrower risk, and competition. So two borrowers with identical credit can still see small rate differences across lenders. Why does 2025 feel so painful? First, we're comparing today to an unusually low rate period in 2020-2021 when 30-year rates were often under 3.5%. Relative to that, mid-6% rates look steep. But in a longer-term historical view, today's mid-6% range is still below many periods in the 1,980 seconds and 1,990 seconds, so perspective matters. Second, core inflation has been stickier than some expected. Even small upticks prompt investors to reprice risk. Third, fiscal pressures, large government deficits can push Treasury yields higher because the government borrows more, increasing supply of bonds, which needs higher yields to attract buyers. And finally, geopolitical and economic surprises, commodity shocks, trade shifts can feed into inflation expectations and yields. Now the million-dollar question. When will rates fall? Read this carefully. Timing the market is extremely difficult, but we can lay out the main conditions that would push rates lower, which are sustained slide in inflation toward the Fed's 2% target and a clear evidence of a slowing labor market or weaker wage growth. As will Brute, most major forecasts during 2025 and into 2026 suggest gradual easing, not a sharp crash in rates. For example, many forecasters see 30-year fixed rates holding in the mid-6% range through 2025, with slow declines towards 6% or slightly below in 2026, if inflation moderates and the Fed cuts as expected. But forecasts vary. Wells Fargo and some others argued that rates could stay higher for longer depending on inflation and fiscal outlooks. Numbers and forecasts are useful, but let's translate them into action. Let's look at the real, practical decisions you'll face and a step-by-step procedure to protect your money and options. Step 1. Get pre-approved with a soft pull first. Start with a soft pull pre-qualification to understand your buying power without hurting your credit. That tells you price range and program fit. FHA, VA, conventional, and USDA. Step 2. Run side-by-side scenarios. If you're under contract, do a lock versus float analysis. Ask lenders to price out both a rate lock, 30-60 day typical, and a float strategy with a float down option. Compare break-even scenarios, that is, how much must rates drop by closing for floating to net you savings. Step 3. Consider alternative loan structures. If the fixed rate feels high, consider ARMs, adjustable rate mortgages, like a 5/1 ARM that offers a lower initial fixed rate for 5 years, or a buy-down seller, interest rate buy-down. Both are common strategies when long-term rates are unattractive, but you plan to move or refinance within a few years. Step 4. Improve what you can control. Boost your credit score, reduce debt to income ratio, increase down payment if possible. Even small improvements can lower your rate. Points can be useful. Paying upfront discount points reduces the interest rate. Do the math on how long you plan to stay. Step 5. Lock strategy and contingency. If you decide to lock, choose a lock window matching your closing timeline, and include a float down clause if possible. If you float, set a target rate that would trigger a lock. Step 6. Plan to refinance. If rates fall materially in the future, have a refinance plan ready. Verify remaining loan balance, current home value, and fees so you can act quickly. Waiting for a big drop can be risky. If mortgage rates fall slowly and home prices rise or remain flat, you may lose purchasing power or face higher home prices later. Waiting makes sense if you expect a near-term major policy change that's all but certain. But in practice, most households are better off buying when a home fits budget and life plans, and then refinancing if rates fall. Here's the bottom line. Mortgage rates are high in 2025 because inflation expectations, treasury yields, and macroeconomic forces are keeping long-term borrowing costs up. Forecasts suggest gradual easing if inflation falls back toward 2% and the Fed can cut, but don't count on a rapid return to 3% rates. Instead, think strategy. Lock when necessary, use ARMs or buy downs when appropriate. Tighten your profile where you can, and always run side-by-side scenarios. If you want a custom rent versus buy and lock versus float analysis for your exact situation, click the link in the description for a free soft pull pre-qualification. No hard hit to your credit, just clarity. Hit like if this helped, subscribe for weekly mortgage strategy videos, and drop your question in the comments.